ICICI Prudential saw its total income double in the last quarter, but not on the back of higher new business premium. Joining us to talk about the numbers is NS Kannan, the MD and CEO of ICICI Prudential Life Insurance. Mr. Kannan, good having you. Thanks much for joining in. There was a slowdown in the last quarter in the ULIPs, especially in the high-ticket clients, and your AP growth came down. Has this quarter too seen that numbers stay soft, especially the high client renewals? And is there any way of being able to predict as to when would this trajectory stabilize or come to an end?
I just wanted to mention that the fourth quarter numbers have been very satisfying for us because if you remember the 9-month numbers, we had registered a 4% decline on our new business APE on a year-on-year basis. Part of the reasons are the market volatility in the third quarter beginning and so on. But if you look at our fourth quarter numbers, you have actually been able to increase our APE on a year-on-year basis by 11%. So we are back to a double-digit kind of a growth trajectory, which is what is quite satisfying in the fourth quarter. And if I look at the products which have resulted in the growth, we have seen all the product lines putting up a positive growth. We have seen whether it is ULIPs or other products in the savings business, they have grown at a good rate. And if you look at protection part of the business, actually it has grown at a much higher growth rate. In fact, for the year as a whole, the protection growth has been around 62% on a year-on-year basis. So I believe that the fourth quarter has been a very good quarter for us, coming back to a double-digit growth on an APE basis.
Okay, let's talk about the AP growth assumptions. We'll start off with that because the street factors in various numbers. 3% in the quarter gone by, and the numbers ranged up as well. And while the protection AP could have grown strong, what's the overall AP growth assumption for FY20 and beyond?
Yeah, I agree with you. I do respect the street, and we had taken lots of measures during the third quarter. And some of the measures included activation of our distribution by introducing products with monthly frequencies in the ULIP, and we continued our journey on the protection, and those have resulted in the distribution getting activated much more and leading to the Q4 performance which we have put out. So to answer your question on the growth outlook going forward, we believe that for life insurance industry, the savings growth rate at the minimum can grow at the nominal GDP growth rate at the minimum. Take 7% kind of a GDP growth rate, add to it about 4% of inflation. So we believe that 11 to 12% per annum kind of a growth rate as an opportunity in the savings side of the business is quite a par for this industry. Within that, if you look at the protection side of the business, I believe that can grow at a much faster rate in the foreseeable future because the under-penetration is very strong in the protection. That means that there is a huge opportunity for increasing the protection line of business. So that can grow at a rate which is higher than the nominal GDP growth rate I talked about. Those are the kind of opportunities we are pursuing as we go forward from the last financial year to this financial year.
Okay, so optimistic on AP growth. The protection business too seems to have grown well, Mr. Kannan. Can you explain the granular growth and what is the direction that you see there?
Yeah, protection growth indeed has grown at a very robust rate. Within protection, we do have an individual protection segment as well as the group protection segment. We have seen growth in both these businesses, and also the credit life business, which is inherent part of the group business, has also grown at a robust pace. So whether you look at the liability protection or income protection, we do see opportunity in both these businesses. And this is a business where customer needs are quite congruent to the shareholder needs in terms of the value accretion. So it is a higher value of new business accreting product, as well as at the same time it is meeting with the customer needs. So it is essentially it is articulated strategy, a focus in terms of our pushing the product through our distribution to the right side segment, customer segments, that has resulted in this kind of growth we have seen. As I said, going forward, we would continue to put out a growth on this product segment. This segment, which was 5.7% of our APE in the previous financial year 2018, had become about 9.3% in the financial year 2019, with the Q4 number being about 10.6% of our overall APE. So we have seen a good traction, not just in terms of growth, but in terms of even the product mix going up. And then we think that we should be able to comfortably keep it a double-digit percentage of our product mix going forward as well.
Okay. One of the key concerns with ICICI Pru Life has been the volatility in the premiums and the knock-on effect on the value of new business and the margins. However, as the share of protection business in total VNB rises, these risks should abate. Is that a fair assumption?
Yeah, see, we have not put out any specific guidance on what will be our target mix in terms of protection mix in the overall business. But having said that, I agree with you partly because if we look at our VNB development, while protection, as I said, constituted about 9.3% of our product mix for the financial year 2019, as a percentage of VNB, value of new business, protection actually is 60%. So to some extent, the volatility of VNB, contributed by the volatility in the savings side of our business has come down somewhat. So it is a reasonable thing to say that the VNB is getting partly insulated from the volatility of growth in the savings business going forward. So I would agree to that extent what you're saying.
Okay. How have your persistency ratios moved in the quarter, Mr. Kannan?
Yeah, broadly we have seen improvement in the persistency on a year-on-year basis. For us, the 13-month persistency is a very critical barometer because that is where the second premium comes into the company. And if the quality of sale was good, if we had explained the product features properly to the customers, if we had explained the possible value delivery from the products which you have sold to the customers properly to them, that means that the second, third premiums will come back. So the second premium is the 13-month persistency which we are talking about. On that metric, we have improved it to 86.1%, which is about a 30 basis point improvement on a year-on-year basis. We look at it with a lot of satisfaction. We have been able to do that because we have made persistency into an operating culture in the company. So in terms of talking to our distribution, in terms of talking to our own employees, we give equal importance to the renewal premium as the importance we give for the new business premium. So that is the kind of culture which has been built in the company, and that has also resulted in the right selling. It has also resulted in the 13-month persistency going up. So to me, the big parameter of a business, a proper business sale is the 13-month persistency, where we are 86.1% for the, just the numbers we have put out for March.
No, but which is fine, which is the 13-month ratio which you think is important. The street is obsessed with the 61st month persistency ratio as well. How has that number come out for you?
Yeah, across the 61st persistency and across the parameters, across the cohorts, we have done better over a period of time. And if you look at even the experience beyond 5 years, which is the surrender experience, there also we are much better than what we expected. So across the parameters, we have been able to deliver a good outcome both for the shareholders as well as for the customers. The net all this, whether it is a 61-month persistency or the surrenders being less, etc., has resulted in a robust growth in our funds under management. If we look at our funds under management as of March, it was 1.6 lakh crore, which was 1.39 lakh crores in the March of the corresponding period in the March last year, 2018. So that becomes a summary, measure of results of whether it is a 13-month persistency or a subsequent period persistency, as well as surrenders being less than what we thought it would be.
My final question, now you're trying to move into the smaller ticket ULIPs side in order to improve the metrics. Would it be safe to assume that it's at least a 12-month journey before that stabilizes and starts showing in numbers?
Yeah, that is a very good question. So if I rewind our performance to the quarter 3, as we had discussed at the beginning of the call, there was extreme market volatility. And given that the high ticket ULIP, there was a sense of postponement by the new buyers of ULIP policies. So even that led to a little bit of inactivity on the part of distributors. So we thought that not just from a medium-term, long-term perspective, but even from an immediate perspective, we thought it is very important to activate the distribution back, help them to have conversations with the customers. That is when we thought that rather than just focusing only on the annual premium paying policies, we should focus on the monthly policies as well. That's when we introduced the monthly ULIP. The good news is that even in moving from October to November, thanks to the introduction of this, we have been able to curtail the year-on-year decline in the month of November itself. In fact, in December, over December, if you look at our numbers, we have been able to marginally grow our APE. So I feel that while it continues to be a good medium-term and long-term strategy, even in the short term, it has helped us enormously in terms of activating the distribution, helping the distribution to have conversations with the customers, and thereby resulting in back to action of the distributors, leading to the 11% growth which we had put in the fourth quarter of the financial year.
Okay, Mr. Kannan, we'll leave it at that. Thanks so much and all the best for the quarters ahead. That's ICICI Pru. Bring up the stock. Started off well, about 1.5% in trade in the green. Currently about 2.5% up in the session. The APE growth numbers and the protection business uptick might be working tricks for the company today. The next conversation is with Hexaware. It was a subdued quarter for the company. Revenue and margins were flat while net profit grew 12%. Agam Vakil spoke to the company's CEO R. Srikrishna and began by asking him about the company's growth prospects in 2019.
There are four factors behind us kind of maintaining our guidance, right? So the first is that Q1 is seasonally a weak quarter for us. In the context of that, 2% sequential growth is actually pretty good. If you look at the second factor, if you look at our Y&Y constant currency growth right now, it's at 13%. That is right in line with what we expect the year to be. The third, the ask rate going forward is about 4% quarter on quarter, and we usually kind of do better than that in Q2 and Q3. So the ask rate is 4% at this point to get the midpoint of guidance, but we actually expect at some point during the year to get ahead of the ask rate. Finally, a lot of our guidance is based on orders in hand. Clearly, there is some amount of book and build ahead of us each quarter, but a bulk of it is based on what we booked last quarter, last year, that continues to get executed through the year.
All right, sir. So let's talk about margins then. Can you elaborate a little more on the impact of rising proportion of on-site revenues on margins? Also, if you could talk to us a little more about competitive intensity, how that's panning out, and also on-site investments and how the kind of impact that they've had when it comes to your operating profits.
Sure. So our on-site business has been growing faster than our offshore business for a while. But it's flattened out now, and we expect actually in the next 3 years that our offshore business will actually grow a little faster than our onshore business, and that will be actually a tailwind for our margins. In terms of investments onshore, actually we have multiple investments onshore for creating skills. Clearly, the labor market, especially in the US, is quite tight. And the only way to fulfill all of our demand is not just by hiring, but also investing in creating skills. And we are doing that. We're doing that not just in the US, we are also doing that in neighboring Mexico.
Okay, so based on your expectations of pricing and perhaps utilizations, can we expect margins to improve going forward in the subsequent quarters?
So we definitely expect margins to improve Q2 and Q3. It happens every year. So there is a clear cyclicality pattern to our margins where Q4 and Q1 are both low, and Q2 is decent and Q3 is really high. That's a pattern that happens every single year. So we would clearly expect our margins to go up actually quite sharply in Q2 and Q3.
Mr. Srikrishna, I've been looking at earnings of your peers, I've been looking at your earnings, and I'm not really been able to pin anything down when it comes to the banking and financial industry and the kind of traction that the entire industry is getting currently. My question really is that what is your observation from your clients from the banking and financial space? What are you reading in terms of trends as to what we can make, say, in the near future?
So at this point, at the beginning of the year, we didn't expect banking financial services to be an important growth driver for us. We had said it's going to grow lower than company average. But at this point, actually, the outlook is a little worse than what it was at the beginning of the year. Across the broad area of clients in the sector, there is a lot of wait and watch. Let me hold on to my money. Let me get a better sense of what the macros are. There's still a lot of uncertainty around the macros, even though all the data that's come in so far, whether it's GDP, jobs report, and we are in the midst of the corporate earnings season, all of it actually looks good. But nevertheless, there is still more than some pockets of people that believe sharp slowdown is ahead of us. And frankly, I think till that uncertainty clears up, this bit of wait and watch in the sector is going to continue.
Right. Mr. Srikrishna, just two more questions. I also wanted to address acquiring NIT Technologies. We do know that this is through different funds. That is, their holding is through different bearing funds. And we also know that for now, all parties have ruled out any possibility of mergers. But my question really is to do with any possible synergies or perhaps sharing of clients, or I don't know, any other possible advantages that can come Hexaware's way through this acquisition of NIT Technologies? Well,
we've laid out our acquisition strategy. We said we want to spend between $250 to $300 million, and that is going to be predominantly focused, and 250 to 300 the next 2 to 3 years, predominantly focused on acquiring new capabilities in the areas of customer experience transformation and in cloud, to augment our capabilities in cloud. Now, we don't actually see those themes fitting in a merger with NIT, right? If we had that kind of capital, we would actually go out and continuously acquire new capabilities and new growth drivers. We don't necessarily see value, frankly, for either company in a merger.
Okay, and
of course, you already said it's in a different fund, so really it is not even possible to execute it for the most part. Yeah.
Okay, I followed, Mr. Srikrishna. Finally, a word on cash. So if I remove the component of the cash that you will give the shareholders back through dividends and whatever other methods, my question then is, how does the balance get allocated towards one, capital expenditure, and how much have you left out to a certain extent for possible acquisitions in this financial year?
So we've been building cash steadily for a number of years. 2 years ago, we stepped dividend down. Market didn't like it, but we did, so that we can build some capital for acquisition. So it's been a very deliberate kind of play to build capital. So at this point, outside the dividends that we do, and even the dividends, we said it may change if you make an acquisition. A vast majority of it is earmarked for acquisitions. We're not a capital intensive business. Typically 1.5% to 2% of our revenue is what goes into capital. Some years a little bit higher if you build out some new buildings, new campuses, but for the most part it's 1.5% to 2% of revenues.
That's Hexaware for you. The stock corrected yesterday, doing reasonably okay today. What corrected big time yesterday was Muthoot Capital. The profitability has taken a hit in the March quarter. To understand the factors that led to this decline, Shefali Malik had a chat with the CFO, Vinod, Panicker. Listen in.
Thanks for having me on the show. I would just want to emphasize on one important point when we are talking about the earnings and or more so about the profitability of this current quarter. This current quarter, maybe to begin with, I need to say that we did a securitization of about 366 odd crores. As per the RBI regulations, we are permitted to recognize the income on securitization transaction only when we receive the money physically from the SPV. Now, in our case, there was an income of roughly 7.02 crores, which was relating to this 366 crores, which was not accounted by us in the current quarter because as per the RBI regulations, you need to defer it to the actual receipt of money or receipt of funds from the SPV. That's the reason this was not accounted in the current quarter. And this is the single largest reason for the income being lower, which obviously led to the bottom line being lower, number one. Number two is the fact that March quarter is a quarter when there are a lot of bank renewals and other things happened. And there were a couple of large bank sanctions which came through. One of them was in the form of a term loan. We spent about 2.7 crores on bank processing fee as payouts. And then I did mention about the securitization transaction. So there was a cost of roughly about 1.4 crores. Now these two are one-time cost or once in a year. The first one is once in a year kind of cost. This is the securitization cost is a one-time cost in the life of the securitization. So these two hits were there. Apart from that, we in spite of all this happening, we took an additional 4 crores additional provisioning on the NPAs just to ensure that our coverage goes up from 43% that was there in the last quarter to 45.3% in the current quarter. All this led to the overall profit looking lower at about 18.3 versus about 23.3 in the immediately preceding quarter.
Sir, you said that you've made extra provisioning this time around because of for some NPA accounts. Could you tell us more about these NPA accounts and about your asset quality? Because I can see that in Q3 your gross NPAs were about 5.5% and net NPAs about 4%. So how did the asset quality pan out this time around?
On an absolute number basis, the NPA last time was about 122 crores. End of Q4, it was at about 113 crores. In percentage terms, 113 crores on an overall portfolio of about 2,741 crores, that looks to be at about 4.3%. If you look at the provision on of the NPA, I mean, if you look at the NPA as a percentage of the book AUM, it is at about 5.3%. The net NPA on the on-book NPA or on the on-book NPA was at about 3.1%. If I look at the overall NPA book, which is including the book, the managed portfolio, because we do securitization, we have got managed portfolio of 656 crores at the end of the year. Including that, if one looks at it, the net NPA is at about 2.3%, gross at 4.3%. So I would say the portfolio in absolute terms, since the NPA numbers have gone down, the asset quality has been good or better than the last quarter.
So, Mr. Panicker, how was the business momentum this time around? What kind of disbursements did you had in the quarter, and at the end of Q4, where do the AUM stand at?
During the quarter, we had a disbursement of 605 crores versus 502 crores that we did in the immediately preceding quarter. Versus comparing with the same quarter last year, the growth was only 2%, but versus the immediately preceding quarter, the growth was at about 21%. This led to the overall loan book going to about 2,741 crores. We started the year at about 2,238 crores. So the overall the growth has been at about 22% on a full year basis.
Sure. So what about the margins? Because it has been a tough quarter and in fact challenging time for NBFCs and financial companies on the whole. So did your cost of funds go up in the quarter, and were you able to maintain the margins?
We were able to maintain the margins mainly because we had increased the price to the final consumer a little bit in the range of about 50 to 75 bips sometime in the month of December. Our cost did go up in the current quarter. In fact, current quarter versus the last quarter, there was a 40 bips increase. We were at about 9.7% last quarter. It has gone up to about 10.1% in the current quarter.
So one concerning point for NBFCs has been the asset liability position. So where do you stand at currently, and what kind of repayments do you have coming up in, let's say, next 6 months or so?
Most of our funding is either it's bank funds. Let us say roughly, apart from the securitization that we do, which is roughly 29% of my total borrowing book, the 64% or 65% is bank funds, which is in the form of CC, WCDL, and term loans. The CC and WCDL, while they come up for payment, it's more of a rollover in the sense that it comes back to me the next day, or in many cases the same day. So while there are payouts which will be there on a month-on-month basis, it's not a payout which is gone forever. It's only the term loans which we pay out, which goes forever, which would be in the range of 20 to 25 crores a month, not in any way big amount.
Okay, so sir, you are into two-wheeler loans and you've also entered into the used car segment. So auto sector has been witnessing a slowdown. So as a lender, what is it that you have been witnessing?
We have seen some bit of slowdown in the two-wheeler segment in the last 2 to 3 months. But the way we would want to tell our investors is we feel that no, this is a temporary phase. Number one. Number two is we are today present in about let us say 20 states, of which it's only in the southern states, and that too in Kerala, that we are fully entrenched. Rest of south, we are reasonably entrenched, but then there's a lot more that we can do. And the other 3 zones, west, east, and north, we have just scratched the surface as of now. There's a lot more that we can do, and that is what will drive our volumes. In fact, we are fairly confident we should easily do double of what the market grows by. The say in the industry is the market should go up by 5-6%. We say that no, if that is the case, our our volume should increase by at least double of that.
All right, so one last question. Leave us with an outlook for FY20.
Ma'am, last year or FY18 when we did a QIP, we had committed to the investors, QIP investors, that we would double our book from that day onwards. From that day to the end of FY20, that's March 20. We were at about 1,700 crores that time. So we had said that we will do about 3,500 crores. We are fairly confident that we should reach that number by the end of the current financial year.
With that, it's a wrap on this leg of Indian Open. Up next is the Vinod show. Thanks so much for watching.